What is up, guys? It's Seth here with another episode of Renaissance Resurrection. Today is a very special episode. It's my first finance video, how to become a long-term investor. If you stick around to the end, I have 3 book recommendations for you. I have 5 different places that you can get access to free market data, and I also have a free PDF version of the checklist that my multimillionaire stock mentor gave me when he first had me do a quarterly checkup on a company. So, let's go ahead and get this money talk in 3, 2, 1. Alright guys, so let me just start off by saying I'm making this video with the hopes that people will see the power of long-term investing and get some practical advice on how to get started. And I really want people to recognize how significant it is that aren't necessarily experienced in investing, how significant it is that your money can make you money. The money that you go out and work hard for, that you earn, can then sit in a place and work for you, can bring you more money just by you having that money in that place, right? So I just want everyone to take a second to think, what did banks do with your money? When you go and put a paycheck in your savings account, you go and make a deposit, do you think the bank just puts it in some sort of cryptic vault where it accumulates dust and they just do a favor and hold it for you so that it's safe? No, that wouldn't be very profitable for the banks at all. Banks take your money that you give them and then they loan it out and they invest it in different securities. They make interest on your money and they're legally only obligated to have 10% of your actual cash value on hand to give you. The other 90% of it, they're taking it, they're loaning it out, they're investing it, they're making interest, they're making a return on your money. Meanwhile, your money's sitting in your account, not growing, it's actually losing buying power. Your money's growing at like a negative 4 to 6% buying power interest rate just by sitting in your account because you're getting outpaced by inflation. So, banks would really hate to start hearing this as a common sentiment, but I believe that people should learn to invest for themselves. I think we should all cut the middleman. Having financial literacy and learning how to invest enables you to defend yourself from predatory financial institutions. And the way I like to say it is, it's kind of like learning martial arts. If someone who's way bigger than you bullies you, it's kind of like learning martial arts so that you can defend yourself, learning financial literacy and investing. And it's kind of funny to me that the reason that I got into mixed martial arts is the same reason that I got into finance and investing. It's because I wanted to be able to protect myself and the people around me from people who seek to do us harm. And you can do harm to people just as much financially as you can do it to them physically. So with that being said, let me go ahead and get straight into it. So as a long-term investor, I am a huge subscriber to the theories of Warren Buffett and the way that long-term, also known as value investing, works. So what it's oriented around is getting you a 10% to 40% return on your money per year, compounding over the long term. So let me go ahead and just show, for those of you, everybody throws that around, compound interest, but not many people actually know how it works. So if you have a $25,000 investment, your principal is what it's called, the very first $25,000 that you put into some good security, right? And you achieve a compounding interest rate of 18% over 20 years. And people are going to say, oh, that sounds very high. My portfolio has done 24% in the last 3 months. So quadruple your time frame and cut your returns by 25%, and that's what you get here. It's absolutely doable. 18% is absolutely doable as a skilled investor. So if you achieve an 18% compounding interest rate on principal of $25,000 over 20 years, that investment grows from $25,000 cash to $684,825. Imagine your $25,000 grows to $685,000. That is totally doable. That is totally doable if you are patient and you have discipline, but that is why most people don't invest this way, because they're not patient and they don't have discipline. They want to get rich quick, and it doesn't work like that. Anyways, $685,000. This is also tax deferred, so the whole while that your principal has accumulated all this interest, none of this has been taxed on an annual, semi-annual, any basis. All of this money, as long as you keep it in the security, grows tax deferred. So that money that would normally be taken out in income tax, it just stays in there and continues to add to your principal. So you have $685,000 tax deferred, and it's passive growth. This is money. If you had that $25,000 sitting in your savings account, it wouldn't grow. If you have this $25,000 sitting in the right security, I would call that growth. Now, here's what I like to do is I like to break it down. Imagine if I came up to you and I was like, hey, I'll let you buy $27.39 off me for $1. Does that sound good? You'd probably say, yeah, I wouldn't mind 27.4xing my money. Well, that's what this is. If you have $25,000 and you achieve this return over that amount of time, and you get to that $684,825 mark, that would mean that every dollar that you put in that investment is now worth $27.39. I don't think any savings account is doing that. So now let me talk a little bit about why I invest long-term instead of doing day trading or trading stocks. So day traders often set the an aggressive goal of making a 2 to 6% return on their money per day. Now, this sounds great in theory, and trading can yield you far greater returns in a very short time frame, but it is less consistent and so much more risky. So what they do is they set these aggressive return goals of 2 to 6% interest on their money per day, or they use really risky short-term stock options which magnify your returns or your losses respectively. You can either make way more money or you can lose all of your money very easily on these short-term options. And so most of them, 90% of options that are purchased and executed end up resulting in people losing money. And that's just how the short-term game in the stock market works. It's so much more risky, there's so much more volatility. And not to mention that day trading, I just have no interest in the way that you have to constantly check your portfolio, have anxiety, be reading the news wires. I mean, I just personally don't care to follow the market with every waking second of my life because I have many other things to tend to that are a little bit more important. So, also the risk of day trading and not being a long-term investor violates one of my principles as a long-term investor, which is to not lose money. So let me explain to you why, as a long-term investor, losing money is a sin. Yeah, it's that bad. Let me explain why. So say you had original capital, your original principal. Say you had $5,000 to invest and you started wanting to invest it. Say you lost 50% of it, half of it, on a bad investment or a bad trade. And trust me, a 50% loss is definitely something that a lot of day traders experience if they don't lose all of their money at some point. So say you have a 50% loss from $5,000, you now have $2,500. Here's why it's so bad to lose money. When you lose money, it's harder to make it back. In order to get from your $2,500 back to your original $5,000, you have to offset your 50% loss with a 100% gain. You now have only $2,500. This $2,500 has to double. It has to have a 100% gain just to get back to your original capital. So you have to double back your losses when you lose money. Your principal can't grow at as good of a percentage because it's a smaller amount, right? So this is why it is terrible as a long-term investor. If you really want to compound, it is terrible to lose money. Now, there's a few other principles of long-term investing which I'm going to discuss here. Now, the very first one is obviously, like I just demonstrated, don't lose money. So the next principle of long-term investing is buy stocks undervalued. So the way I like to explain this is, say you go into the grocery store and you see chicken and hamburger and steaks, and you have to decide what you're going to have for dinner tonight. I don't know about y'all, I like steak. I think out of those three meats, the best one is steak. But the thing is, a steak is often the most expensive, right? Because everybody likes it, except for vegans. Nothing against y'all, but I like steak. So when you go into the store one day and you see that steaks are half off, you're probably gonna buy a lot of steaks that day. So what I do is I go out and I find companies that I like I like steak. And I figure out what are those companies actually worth on a financial basis? You can literally do through a variety, and you can employ a variety of different mathematical financial concepts to determine the fair value per share of a company in the stock market. So I go out, I determine that, and if I find that that company is a great company with great long-term growth economics and it's selling at a discount, it's selling like a steak that's half off, I'm going to go buy that company on sale like I'm buying my steaks on sale. And the beautiful thing is that if you buy a company, I like to look for companies personally that, like I said, I want them to be great companies, but I also want to buy them at 2/3 of their fair value is my goal. So if it's trading at a 33% discount and it's a great company long term, I like that. And so what buying undervalue does is it sets you up to be in line with the third principle of long-term investing, which is having a margin of safety. The margin of safety is simply what percentage is this stock undervalued. So if I buy a company that's trading at 2/3 of its fair value, that means I have a 33% margin of safety. Meaning, even if I buy the company and it dips, I know that the company is actually worth more than what it just dipped down to. So if I know that, and I know the company has great long-term growth economics, and the dip was some sort of artificial thing that hit the news and people overreacted about, I'm just gonna buy more of that company. I mean, what if you walked in to get a steak and it was 33% off, and then the next day you walked in and it was half off? You'd probably be like, oh my god, I know I still like steak. I know it's a great cut. I'm gonna get more. That's what it is. You buy the dip, and that's how you find these companies that are trading undervalued, that have these great long-term growth economics. I'm getting so excited here because I'm so passionate about this stuff. And then you make sure you have that margin of safety, and you continually assess what it's really worth and just let it grow. Now, the next principle of long-term investing is you look for companies that have a moat. There's so many different kinds of economic moats. I'm going to make a completely separate video just to discuss moats in the future. But a moat is, let's keep it basic for this video, is anything that gives a company a durable competitive advantage. But like I said, there's so many different types of economic moats, but you think about a castle, you think about the actual moat, the ring of water, and the alligators around it. Different companies have that type of thing in their industry where they actually have a moat. They have something that keeps them durably competitive. And then the very last principle of long-term investing, as we discussed over here, is to hold long-term and let compounding interest work. The only time that you should sell is if a company starts to trade exceedingly high above its fair value, or something happens that completely changes the fundamentals of the company. Other than that, the best stock you can hold is the one that you never have to sell, because it just continually makes you money as an asset. Now, look guys, I know that this all might sound a little bit overwhelming, but trust me, you will get it in time. This stuff all took me a lot of time and hard work to learn. I mean, this stuff takes patience and discipline, and that's why most people never do it. But if you made it to this point in the video, I take it serious that you might actually be interested in doing what you need to do to get your financial freedom in the future, and just have faith that I will be making future videos and explaining all these concepts in depth, and there's tons of other resources out there where you guys can look up the things that I've discussed here today. But let me go ahead and take a step back for the people that are saying, Seth, I really like this and I'm excited about it and I want to do this, but I have no idea where to get started because that all sounds really complicated. I'm going to go ahead and give you some practical advice on how I would get started and how I did get started as an investor. So the very first thing that I would do is I would read this book called Little Book of Value Investing. This book really goes into the theory and uses analogies and examples and all kinds of non-financial jargon to start to explain how long-term investing works for you. It's not a crazy finance-oriented book. It really breaks down the different financial metrics and gives you an elementary explanation of how you should go about looking at finding great long-term investments and valuing companies. The second book that I would read gets a little bit more nitty and gritty on the finances. This book is called Interpretation of Financial Statements by Mary Clark Buffett, I believe. I'm going to put a picture on here so you guys can see it. I forgot my books when I left my house to come to the office, so it is what it is. But This book goes in depth on the application of the theoretical information that you're going to learn in Little Book of Value Investing. So interpretation of financial statements will show you how to really explore a company based on their financial statements and break down what's happening with that company off the numbers. And then after you read Little Book of Value Investing, after you read Interpretation of Financial Statements, the third book that I recommend every person who is considering becoming a long-term investor read is Intelligent Investor by Benjamin Graham. Benjamin Graham was the mentor of Warren Buffett, and this book really opens you up to a new level where you start to realize the capacity of mastery in finance, and it's a very high-level book, and you can almost see into the matrix when it comes to what's happening in a company. It shows you all the different ways that you can manipulate the numbers in a company and see what's really happening with them just by breaking down their numbers. Now, as far as free market data goes, where can I go to get access to all this financial information? Seth, I'm going to go ahead and give you some good platforms. So the ones that you can use are Morningstar and Value Line. If you go and you make a free Houston Public Library electronic membership card, you actually get free access to Morningstar and Value Line. So go look up Houston Public Library electronic membership card, make a free account, get access to that market data. Great tools. I use it all the time. The next one that you can use is Yahoo Finance. Yahoo Finance is free. It gives you access to all the company's financial statements, charts, historical reporting, all kinds of fun stuff. The fifth resource that you can use is the SEC, the Security and Exchange Commission's website, to look up companies' different reports, like their annual reports and their quarterly reports. I would hold off on that though until you've read the books, because if you look at a company's 10K or 10Q and you haven't gotten any sort of financial jargon or financial literacy under your belt yet, that can kind of look intimidating, so I would hold off on that. But looking at a company's annual reports is the best way to get information on the company, because those SEC reports, if there are false statements on there, those executives in the company go to jail. So it's a very reliable source of information, although it can be overwhelming. And the last thing I would say is that every 3 months, companies have quarterly earnings calls to talk about how their company did in the previous quarter. So if you're considering investing in a company, I would listen to their quarterly earnings calls so that you can kind of learn the language of the industry and see what the key management in those companies is doing to steer that company forward. And lastly, to get you started right, I want to offer you a free PDF checklist. It is the checklist that I received from my multimillionaire finance and investing mentor when I became a senior financial analyst in the portfolio management group that I was a part of. The link to get that free PDF on how my mentor taught me to do quarterly checkups on company is in the description below. I will also put the links for those book recommendations down below, but I believe other than that, I'm pretty much done. So please like this video, please share it with someone that you think would benefit from hearing this information. Subscribe to my channel for more like this. I make tech content, I make finance content, and I make personal development content. I'll be delivering my first tech content here soon. So go ahead and subscribe if those types of things interest you. Comment what your biggest takeaway was down below, what you were most impressed by, what you were most wowed by, what you didn't know, what you learned. Comment that down below. And follow me on social media. Don't miss my announcement for my next video on Sunday. You can have me on Snapchat. My Snap is Seth56LG. My Instagram is Seth.Allen1919. You can find me on Facebook or LinkedIn, Seth Allen. So follow me on social media so you don't miss the announcement for my next video. Other than that, guys, this has been Seth Allen with Renaissance Resurrection on how to become a long-term investor. Thank you guys for tuning in, and I wish you luck on cultivating new knowledge that will contribute to you gaining financial prosperity in this overly abundant world that we live in. Until next time, everybody, I'm out.